How can passive income investing actually make you a better investor? Sounds backwards, right? But here's why it works. If you've read any trading psychologists, like the late Mark Douglas or Randy Howell, mindset is often the biggest thing holding people back in investing. Most investors struggle not because they don't know what to do, but because emotions take over. Fear, greed, impatience, these keep people from following the simple fundamentals. Buy low, sell high. But instead of spending late nights reading about your problems, there's a way to train your brain while making money at the same time. Here's the trick. Start with passive income investing. This means investments that consistently generate income without constant management. The beauty of this approach is that it trains two things at once: patience and your brain's reward system. Every time you receive a dividend or passive income payout, your brain gets a small reward, a little dopamine hit. Over time, this reward reinforces good habits: holding steady, following your plan, and not panicking when the market dips. At the same time, passive income teaches patience. You see money growing slowly but steadily, week after week, month after month. You learn that wealth isn't built overnight. It's built through consistent, smart actions. So instead of fearing market drops or impulsively chasing trends, your brain starts associating disciplined investing with positive feedback. You literally train yourself to stay calm, think long-term, and make smarter decisions. So how do you get started? Focus on high-quality dividend stocks or ETFs with consistent yields. Start small, reinvest your dividends, and over time, you'll see both your income and your investing skill grow. Here are 3 examples of lower risk, higher reward ETFs with consistent yields. QDVO. Current yield is about 12%, which breaks down to roughly 1% per month. With dividends reinvested, QDVO has actually outperformed QQQ over time. The beauty? It's lower risk than holding a single stock. And as you snowball your dividends into more shares, you don't have to sell any if you want to withdraw income later. QDVO pays a monthly dividend. Next up is WPAY. This is a newer fund, so there isn't much historical data yet. It's a basket of stocks including NVDA, AVGO, TSLA, and others. The current yield is around 80%, which works out to roughly 6% per month. It's slightly higher risk because the fund uses swaps, but the high yield can be appealing if you're comfortable with that risk. This fund pays every week. And finally, BCCC. If you believe Bitcoin is going up, BCCC is tough to beat. It currently yields about 38%, roughly 3% per month. BCCC uses a combination of covered calls on the VanEck Bitcoin ETF, while the other 50% of shares are positioned to capture maximum price gains. This fund also pays every week. Let's say the 3 tickers we just covered generate an average of 3% per month. If you start with $5,000, that's about $150 a month. If you start with $20,000, roughly $600 a month. And if you start with $50,000, around $1,500 a month. And remember, reinvesting those dividends over time snowballs your income, letting both your money and your portfolio grow steadily. Want to maximize the benefit? Use a Roth IRA. All that passive income can grow completely tax-free. Consistency is everything. Reinvest your dividends, stay disciplined, and over time, you'll see your portfolio and your investing skills snowball together.